In just 6 weeks, markets faced unprecedented volatility. A major geopolitical conflict unfolded, driven not by military actions but by social media posts. The president's statements shifted oil prices and stock markets instantly. This rollercoaster affected investors worldwide. The conflict began with oil prices at $67 a barrel. As tensions rose, they soared to nearly $120. A brief ceasefire announcement triggered a dramatic 16% drop in crude oil. Stocks surged and Treasury yields fell. Yet, just days later, a breakdown in negotiations reignited chaos. Trump's announcement of a naval blockade pushed oil back up. Seasoned traders likened the past weeks to an exhausting endurance test. They highlighted a new market dynamic lacking historical precedent. Investors learned to interpret tenuous links between political statements and market movements quickly. Financial markets previously needed time to digest political risks. Traditional geopolitical events follow a measured process, while Trump's statements disrupt that. His tweets can result in instant market reactions, overwhelming analysts. As an example, a Trump declaration stating Iran would not attack neighbors dropped oil prices sharply. Contrastingly, his "complete destruction" comment caused a surge. Trading systems react to presidential statements before humans can analyze them. The unpredictability surrounding Trump's words generates a new kind of risk. Markets now swing based on interpreting presidential intent. This shift creates unique challenges for traders unaccustomed to such rapid changes. Looking at March 7th to 9th, we see extraordinary market dynamics. On the 7th, a post led to a brief relief rally. Oil prices dipped, and stocks rose. However, the next day, the markets reacted violently to escalating rhetoric. Investors witnessed a significant market reversal. By the 9th, the uncertainty peaked again. Trump hinted at taking control of the Strait of Hormuz, creating confusion. The markets reacted with heightened volatility as they attempted to gauge the future. The oscillation in oil prices and Treasury yields exemplifies market complexity. Early in the conflict, higher oil prices led to rising yields. Over time, this correlation shifted, reflecting recession fears as high oil prices persisted. Traders face challenges as they attempt to hedge positions. Managing the intricate relationship between rising oil prices and shifting yields complicates decision-making significantly. Moreover, as the war stretched on, the market's reaction to Trump's statements grew muted. The massive relief rally after the ceasefire announcement, while robust, was smaller than previous market responses to Trump's earlier statements. Investors have reduced their sensitivity to Trump's rhetoric. The evolving sentiment demonstrates a learned skepticism among traders. Many factors now affect market dynamics, requiring cautious approaches. The goal is to avoid being caught off guard by sudden reversals. Examining sector performance reveals winners and losers. Energy companies thrive, capitalizing on higher oil prices, while defense stocks see growth due to military needs. Conversely, airlines and manufacturers struggle with rising costs. Such disparities highlight the underlying economics driven by the war. As the geopolitical situation continues, specific sectors will continue to create vast opportunities. As we look ahead, the future remains uncertain. The U.S. blockade and stalled negotiations raise questions. Investors must prepare for multiple outcomes amid fluctuating oil prices. Ultimately, a critical issue lies in Iran's nuclear program. The gap between U.S. and Iranian positions complicates negotiations. Markets are pricing various scenarios, balancing between swift resolutions and extended conflicts. The muted market response to Trump's blockade shows investors expect some form of settlement. In conclusion, recent weeks showcase the necessity of a new trading manual. A market now driven by social media requires traders to adapt swiftly. Establish core principles, avoid overcommitting, size trades wisely, and differentiate between signals and noise. Maintain exposure to energy assets while accepting shifting correlations. Experiential traders advise patience and discipline. In today's trading environment, sometimes, the best move is no move at all. So, wait for clarity, accept smaller gains, and sidestep volatility. In this market, let discipline guide your actions. Asterisk, end card, stay ahead of the game in this unpredictable market. Think strategically.